So what exactly is quantitative finance? At its heart, it's really a search for order. It's this incredible attempt to use some seriously powerful mathematics to try and tame the wild, chaotic world of financial markets. And it all boils down to answering one fundamental question.
Now, this isn't just some deep philosophical thought, right? It is the fundamental challenge for anyone trying to navigate the financial world. I mean, every single day, trillions of dollars are zipping around based on decisions made in the face of just immense uncertainty. So how in the world do we even begin to make sense of it all?
I love this quote. It just perfectly captures the problem, doesn't it? You look at a stock chart, and it looks like pure chaos, just this random, erratic scrawl. But what if there's a mathematical language that could describe that zigzag? Well, the first step, believe it or not, is to just lean in and embrace the randomness itself. To get a handle on this, the quants, that's the quantitative analysts of finance, they start with a surprisingly simple, almost funny idea: the path of a drunkard.
A random walk is, well, it's pretty much exactly what it sounds like. Just picture someone who's had a little too much to drink. Every step they take is completely random. It has absolutely no connection to the step they took just a second before. Now, it's a powerful metaphor because it lets us build a model from pure, total unpredictability.
Let's make this real. Okay, you start at a point. You flip a coin. Heads, you take a step up. Tails, you take a step down. Now do that again and again and again. While any single step is just a 50-50 toss-up, the path you end up creating over hundreds or even thousands of flips suddenly looks a whole lot like those spiderweb stock charts. We've just used a dead simple random process to create a complex, unpredictable pattern. Pretty cool, right?
But we need to get a little more sophisticated here. A simple random walk, it's not quite right for stocks. I mean, think about it. A $1 jump is a massive 10% gain for a $10 stock, but it's only a 1% blip for a $100 stock. See the difference? So this is why quants use a more realistic model. Instead of fixed steps, the steps are proportional to the current price. And that idea, which has the fancy name geometric Brownian motion, is the real foundation for how we model stock prices.
Okay, so if we can model randomness, that leads us to an even bigger, crazier challenge. How do you put a price on something when its value depends entirely on that random future?
This is an absolutely crucial distinction. Owning a stock? Pretty straightforward. You own a tiny piece of a company. But an option is totally different. It's the right to buy or sell that stock at a set price sometime in the future. Its value today is completely tangled up in what we think that stock might do tomorrow. How on earth do you calculate a fair price for that?
This is where the magic happens. Back in the 1970s, three guys, Fisher Black, Black-Scholes, and Robert Merton, developed a formula that changed finance forever. The best way to think about the Black-Scholes model isn't as some scary equation, but as a recipe. It takes a few key ingredients, you mix them together, and poof! It gives you a theoretical price for an option. It was a complete game changer.
But look, the model isn't actual magic. The way it works is by creating this perfect, idealized little world. It makes a bunch of assumptions like there are no transaction costs and volatility is always the same, which of course isn't true in real life. But the genius of the model is that inside this perfect theoretical world, it becomes possible to build a portfolio that hedges away all the random risk, leaving you with just one single logical price. It's a theoretical price for a theoretical world, but it gives us an incredibly powerful place to start.
So what was the big deal? Well, before Black-Scholes, pricing an option was mostly just guesswork. This model gave everyone a rational framework, a common language for pricing risk, and that, in turn, unlocked the entire modern derivatives market, a system that's now valued in the, well, quadrillions of dollars. It's mind-boggling.
So, having these amazing tools to model and price risk is one thing. But when you have quadrillions of dollars flying around, the real question becomes, how do you use these tools to avoid, losing everything? This brings us to the actual science of managing risk itself.
The very first rule of risk management is probably one you already know: diversification. Don't put all your eggs in one basket. It's that simple. By spreading your investments across different things, stocks, bonds, real estate, whatever, things that don't all move in the same direction at the same time, you can lower your portfolio's overall risk without necessarily giving up your returns. It's your simplest and most powerful defense against the unknown.
Now, these financial tools create this fascinating marketplace with two main kinds of players. On one side, you've got the hedgers. Think of an airline. They know they're going to need jet fuel in 6 months, so they use a derivative to lock in a price today. They're playing it safe, protecting themselves from a surprise price spike. On the other side, you have speculators. They're the ones who take on that risk, betting that the price will move in their favor. And they're totally essential because they provide the liquidity that allows the hedgers to make that trade in the first place.
So how do these huge banks and hedge funds manage all of this risk? Well, they try to boil down their entire portfolio's risk into a single number. And one of the most famous metrics is called value at risk, or VAR. And it might look a little something like this. And this is what that VAR number is actually saying. It's a statement about probability. It is not saying we won't lose more than $1 million. Nope. It's saying there is only a tiny 1% chance that we're going to lose more than $1 million tomorrow. It's a way for regulators and managers to get a quick snapshot at the potential for a really, really bad day.
And this brings us to a really crucial reality check. These models, they're incredibly powerful, but they are just maps of the world. They're not the world itself. And sometimes, the map is just plain wrong. So right here, we can see the gap between the model and reality in stark terms. We're looking at some data from the German DAX stock index. A perfect, clean statistical model would expect that kurtosis metric to be 0. But look at the actual data from the real world. It's 5. So what does that huge difference actually mean?
It means that reality has fat tails. Kurtosis is just the nerdy technical term for it. But in plain English, it means that extreme, market-crashing, holy cow, what just happened events, they happen way more often in the real world than our neat and tidy models predict. The models are pretty good at describing the everyday zigzags, but they really struggle with those giant, disruptive leaps.
And this really highlights the need for a good dose of healthy skepticism. See, a lot of these models are built on what's called the efficient market hypothesis, this idea that prices always reflect all the known information. But as this quote reminds us, it's just a theory. A useful one, for sure, but one that doesn't always hold water. And here's why that gap between the models and reality is so persistent. Models can be overfitted to past data, meaning they work perfectly on what's already happened, but fall apart on anything new. The model itself might just be wrong. That's model risk. They can be blindsided by black swans, events so rare and huge that they are, by definition, impossible to predict. And maybe most important of all, models have a really hard time accounting for the most random variable of all, us. Human beings driven by good old-fashioned fear and greed.
Which leaves us with this central, nagging question, doesn't it? Quantitative finance is this monumental attempt to impose an elegant mathematical order on the financial markets. But is it actually capturing the true nature of the system? Or is it just a super sophisticated map of a territory that's ultimately governed by the irrational, unpredictable, and deeply human forces of the crowd? You know, that tension right there? That's what makes this whole field so endlessly fascinating.